Hi everyone, my name is Taylor and today we are going to be discussing the revenue recognition principle. Specifically, we are going to be reviewing the following learning objectives as shown on the screen. Alright, let's get started. So firstly, let's start off by defining the term revenue. Revenue is defined as an increase in resources resulting from the sale of goods and services. So goods refer to tangible items such as food, clothing, and furniture, whereas services refer to an action or activity provided, such as getting your hair cut, going for a medical checkup, and receiving mail delivery, just to name a few. So now that we have clarified revenue, let's talk about the revenue recognition principle. So the revenue recognition principle is the principle that revenue should be recorded when a resource is earned and not just when cash is received. So let's unpack this definition a little bit by examining two examples and identifying the associated key concepts. So, example 1. Imagine you work for a food catering business, and on the 1st of March, a customer makes an advance payment to cater a birthday party, taking place on the 1st of April. The revenue recognition principle states that, regardless of when the cash is received, the revenue will be earned when the good or service is provided. So this means that the revenue will be recorded on the 1st of April, when the catering service is delivered to the customer. So this is an example of deferred revenue, which is defined as revenue earned for goods or services which have not yet been delivered. So now, moving on to example 2. So imagine your close friend owns a hair salon. On the 1st of January, you have an appointment to cut your hair. You pay for this service on account with 30-day payment terms. So simply, the service was paid for at a later date being the 1st of February. Keeping the revenue recognition principle in mind, this means that the revenue will be recorded on the 1st of January when the service was delivered and therefore earned. So this is an example of accrued revenue, which is defined as revenue that has been earned by providing a good or service but for which no cash has been received. So now that we have a better understanding of the revenue recognition principle, let's identify how and where it's utilized in accounting. So the revenue recognition principle is applied to the following. So number 1, the statement of comprehensive income, which is defined as a summary of an organization's net assets over a given period of time. And number 2, adjusting entries, which ensures compliance with the revenue recognition principle and the matching principle under the accrual basis of accounting, meaning that revenue was recorded when earned and expenses are recorded when incurred. So finally, after learning all about the revenue recognition principle, this leads us up to our final question being, why is it important? So, in summary, the revenue recognition principle sets a standard for compliance and therefore is essential to maintain accurate, consistent, and reliable financial information within a business. Thanks everyone for listening.